All right, Mr. Scott Davis, how are you, man? Great to
Good,
see
man.
you. Great to see you. Long
Thanks, man.
time, no talk. But so for the people who don't know who you are for the podcast today, tell us a little bit of who you are and what you do.
Yeah, my name's Scott Davis. I'm with Atlantic Coast Mortgage. I've been a lender for, 20 years now. It's kind of crazy to say I've been doing this for that long, but yeah, 20 years now.
Yeah. So, I mean, for a lot of people, mortgage lending is not their first choice of career. So what was
Right.
your kind of turning point to get you into this space?
Yeah, I've been saying that, like I said, for the past 20 years. No one grows up wanting to be a mortgage lender. You know, they don't come into recess wearing a tie and glasses and holding a briefcase.
Yeah,
Or a real estate agent. You know, they want to be cowboys and astronauts and firefighters and
sure.
Marines. You know, so I did the Marine thing, and then when I was done with that, I was a little lost. I wasn't sure exactly what to do, and the girl I was dating at the time, her dad had been doing this for, probably 30 years himself. He was really good, and he kind of gave me the momentum. He said, "Come on in, I'll train you." And you know, I was rookie of the year for my company that very first year, and never looked back.
perfect. Love it. So
Yeah, it's
I'm
good
taking
stuff.
it you've been pretty successful in this career over your 20 years,
Ups and downs.
Yeah.
I mean, success is measured, different ways by different people.
for sure.
I think the more people that I can help, I think that's being successful.
Definitely,
I've been able
definitely.
to help like, a lot of families every year, and that's been awesome.
For sure. Awesome. Well, most people in 2023, the talk of the town is interest rates being so crazy high, and now they don't want to buy. They want to wait until 2024 or 2025, or mortgage lending is just going to collapse, period, because rates are so high. So what are your kind of thoughts on that?
Well, to be honest with you, when I first got in the business, if I could get somebody a mortgage that started with a 6, they were naming babies after me.
Yeah.
But now, if I don't get them a 3 or a 4, they're like, "Oh my gosh, highway robbery! We can't afford this." So really, the gist of the whole message that I try and get across is it's not about the rate. Now let's take that emotional piece out of it and not worry about the number itself. Let's start with your budget. Let's line item everything out. I try and take a holistic approach and look at everything, and it starts with the budget. So once we get through all those numbers and get to it, your monthly payment, this is what you can afford monthly and be comfortable. We don't want to get families into a home where they're eating ramen noodles off egg crates because they're house poor. So we kind of figure out a budget, figure out what they want, and based on their down payment, their credit scores, and different factors, this is your monthly payment. This is what you're comfortable with, and then we kind of go from there.
Right.
We kind of don't talk about the interest rate. We talk about the monthly payment because that's really the most important piece.
Sure.
And we do a lot of debt restructuring. People want to put 20% down. You don't have to. It's a myth. They think they need to put a certain amount down, or they have to be a first-time home buyer to qualify for FHA. So all these myths we kind of combat.
Right.
If they want the lowest payment possible, they want to put 20% down. Well, let's look at your overall debt structure. Maybe we put 10% down instead of 20, but we take that 10% and allocate it towards your debts. So now instead of putting 10% down and you're saving $350, I'm going to make these numbers up, 10% down and saving $350 a month, we take that 10%, pay off high interest credit cards. So now your cash flow, you're saving $700 a month. So your net positive cash flow is $350 a month.
Because your debt has just gone down because you paid more.
Right.
Got it.
Right.
So we talked about a little bit, having a higher 20%. The world knows about 20%. We also know about 3.5% with FHA.
Right.
What are the major loan types that you're seeing that you and your clients work with?
We handle everything here from first-time home buyers doing 3%. We work with Virginia Housing where we can do a combination of things. We have some grant programs that are awesome. It's kind of tricky when you're getting into programs where people have no money down. You got to put on a little different hat and make sure you're not putting people in a bad position.
Right.
We need to make sure that, again, they're not house poor and they're not in a position where if something happens, they can't buy food or fix their car or take care of their family.
Right.
But we work with 3% down, VA loan, 100% down, USDA. So this business definitely is not a one-size-fits-all kind of industry.
Right. But so most applicants are typically kind of looking for conventional or FHA, right? Would you say?
For the most part. Yeah.
So what would you say the major differences are between those two loan programs?
Right now, the big buzz a couple months ago was LLPAs, which is loan level price adjustments that the GSEs, which are the government-sponsored entities, which are Fannie and Freddie, which they're still in conservatorship with the government. They put in these price hikes, price cuts, depending on your credit score. So it really still depends on where your credit scores are, and that model is changing here in the next few months as well, or next few years. They're gonna implement a different model that hopefully is a little more fair on how to analyze folks their credit scores. So typically anything less than a 680, you're going to want to probably go FHA, just because of the mortgage insurance piece, the overall credit profile. You're going to get a little better option, and you're going to be able to afford have a little bit more of an affordable payment.
Okay, but what about the mortgage insurance that comes along with that FHA loan?
Yeah, a lot of folks don't understand that the lower your credit. I mean, everyone knows that if they have a lower credit score, their interest rate's going to be higher, or their fees are going to be a little bit higher. But you also take into consideration that the lower credit scores, you're going to pay a higher mortgage insurance piece too, except with FHA. That is not credit driven. You can have a 650 credit score or an 850 credit score. Your mortgage insurance payment is going to be the exact same. Or on conventional, if you have a lower credit score, that mortgage insurance payment is going to be a little bit higher, or the cost to get out of it is going to be a lot more expensive.
For sure. Awesome. So valuable information. So, for someone who in 2023 is looking to get qualified for a loan, what would you say the average rates that you're seeing right now in the industry are?
Yeah, I kind of olay that question.
Okay.
Because there really is no average question. Like I said earlier, there is no one size fits all.
Mm-hmm.
If you go in and apply for a mortgage, your rate's going to be 6.5. You're buying a condo, 500,000. 10% down, it's going to be, I'm making numbers up, it'd be 6.5. I go in, I'm buying the exact same condo and the exact same project. My rate's going to be 6.9.
Mm-hmm.
So it all depends on so many different factors that we have to kind of put in there.
Sure, but obviously, given 2022, I'm sure there's a huge difference between 2022, 2021 versus now, right?
Mm-hmm.
Would you say?
Yeah, definitely.
Okay, and do you think anytime in the future you see those rates coming down at all?
Yeah, they're definitely be coming down.
Okay.
I don't think we'll ever see 2%, 3%, but I also don't think we ever should have seen 2% or 3%.
Okay.
That's just artificially low.
Sure.
And it's really a detriment. It's kind of what we call unintended consequences. Because now I think all those low rates that we had for 2 years is creating a log jam in the inventories. Right now across the country, not just here in the DC metro area, but we have a log jam because there's no inventory. There's no inventory because people that have a 8,000 square foot house, they're on top of the pile. They normally downsize, so they sell us. They're empty nesters with an 8,000 square foot house. They come down, they buy this entry level house because they're empty nesters. They're like, well, why am I going to sell this $8,000 house that I have a 3% rate on, and I'm going to get a 6% rate and have the exact same mortgage for half the house? So they're just shutting off the top level of this house, staying in it. So this move up buyer can't buy this house. This guy can't come in here. This guy's not buying down here. So it's really a logjam created by those artificially low interest rates.
Right. Now everyone thinks, 2 and 3 is the normal and 6, 4, 5, 6 is the unnormal, and it's going to go back to 2 and 3.
That gets into age brackets, depending on how old you are.
Yeah.
If you're under 35, you think 2s and 3s are normal.
Yeah, that's what I think is normal. But obviously, what you just said kind of applies to that. So
I'm not under 35, so
awesome.
A little bit over.
Sure. What would you say for someone like myself who is looking to get qualified for a mortgage? The 5 easy and maybe the 5 first steps to get qualified for that mortgage.
Step number 1: call Scott Davis.
Okay, sure.
Or call your lender. Call a couple. And all kidding aside, you should definitely interview lenders because lenders are not a one size fits all either.
So you think talking to multiple lenders before you actually make the final say is?
It can be overwhelming. So multiple, maybe 2 or 3.
Okay.
Because any more than that, we all get our rates from the same place. They're not going to be much more than an eighth or a quarter different in price. So in my opinion, there's some great internet lenders out there. There's some great bank lenders out there. But for me personally, I would recommend if you're my brother or my dad or my best friend, I would say stay local. Call somebody that has a local phone number. They're available in the evenings or available on the weekends. They're going to be there for you.
Right.
The peace of mind through this process is worth paying a premium for.
Sure. And so obviously with each process, you've got to get the credit check, the underwritten process. But for someone who's concerned about their credit score being hit multiple times by a lender, what do you say to those potential prospects?
Well, anytime you get your credit run within a certain window, it's basically within 30 days. Within a like industry. The model, the FICO model, Fair Isaac & Company, that model knows that if you're going to ABC Mortgage, XYZ Mortgage, Scott Davis Atlantic Coast Mortgage. You like that plug?
Yeah.
The model understands that in order for me to give you an accurate quote, or for the other lenders to give you an accurate quote, we have to have our credit run. So anything within a 30-day period only counts as one hit.
Okay.
And the same with a car. So if you're buying a car, they know if you go to Ford or Chevy or different dealerships, their finance people have to have their own credit.
Gotcha.
So same thing. It doesn't work for credit cards or anything like that, but any kind of installment loans, they know if you're shopping for a loan like that, it's only going to count as one.
Gotcha. So summary, within 30 days, then you can get pre-approved for as many mortgages as you want with different lenders.
Right.
Same, obviously the same mortgage, but with different lenders, and it will only impact your score the one time.
Correct.
Awesome. So what would you say the other steps are in that process?
Getting a feel for your budget.
Okay.
A lot of people want, the first thing they do is they call me, hey, Scott speaking, what's your rate?
Yeah.
And that's the number one, we spoke about earlier, it's the number one concern. Well, let's back up a little bit and see, okay, what kind of home you're trying to buy, how much down payment do you have, what's your budget? Because when I answer, especially a few months ago when rates were in the high sixes, low sevens, if I answer that question, your rate's 7%, the conversation's over.
Right.
They're like, no, thank you, I can't afford it.
Yeah.
Because mentally, they remember the 2s and the 3s and the 4s, and now the 5s and the 6s.
Yeah.
So they hear a 7 and it's over. But if I answer, well, kind of let's back up, let's peel it back. What's your budget? Have you line itemed out? Do you have a budget? And if they don't, I kind of coach them through that, and I have all the forms and docs I can help them fill out. So they're kind of following a budget to get into this. So once I do all that, I peel those layers back, and we go by their down payment, we figure out their credit score, and they're like, well, the monthly payment, we want this. I'm like, all right, based on all that, your high side loan amount is $450,000, and your payment is $3,700. And again, I'm making these numbers up. When I have that conversation, they're like, okay, that's exactly where we want to be. And then we get into the rate, like, oh, okay, that rate's a little bit higher than we were expecting. What can we do to get it down? What should we do? But that's a much easier conversation, much better, because we back ended into it. Because they're comfortable with the payment, they're comfortable with the affordability. It's just that emotional number that they don't like.
Right. And you can maybe overcome that by buying points, getting the seller to pay for some of those fees.
Yeah, we
Right.
have temporary buy downs. Which is a 2-1 type thing.
Okay.
Where they're if the rate is 6.5 today, for the first year it's 4.5, the second year it's 5.5, the third year it's normally 6.5.
Okay.
And I think we're going to be in a refinance market within the next 24 months anyway.
Okay.
So
Wow.
doing that buy down is a great option. Doing an ARM, we have ARMs that are in the 5s. That's another great option. The way an ARM works is it's fixed for the period of the ARM, so a 5-year ARM. The rate is fixed for the first 5 years, and then for the next 25 years, it's going to adjust.
Okay.
But again, they can refinance out of that with no penalties.
Right. So what is an ARM?
An ARM is an adjustable. Great question.
Sure.
I usually don't use acronyms.
Yeah,
for
yeah.
that exact reason.
Right.
An ARM is an adjustable rate mortgage.
Okay.
It's adjustable after the fixed period. So
Okay.
a 5-year ARM, it's for 60 months. It's fixed at whatever rate it is, and then for the next 25 years, it'll adjust.
So are ARMs typically cheaper in accordance to what current rates would be, would you say?
Yes.
Okay.
ARMs typically have a lower initial rate.
Okay. And you think, maybe for someone, average consumer who's looking to purchase now, maybe they should go with an ARM, and then after maybe 2, 3, 4 years, look at possibly the option of refinancing then.
Yeah.
Okay.
And again, this gets into the holistic picture. And how long are you going to be in the house? Are you government? Are you military? Are you only going to be here 3 years anyway? And if you're only going to be here 3 years, why pay a 6% rate when we can get you a 5 and change rate?
Right.
Because you're going to be out of here in 3 years.
Right. So, with most loans, most people actually don't know this, but I remember you told me that for residential loans, you have to occupy, a lot of people want to obtain a residential loan to get a lower interest rate to buy an investment property versus just getting a straight up investment property loan.
Right.
And most people don't know that for the first year, you have to reside in the property.
Right.
So is that kind of standard with all loans, or what is the difference between, just going that residential route versus, maybe it might just be a better option to put you in an investment loan?
It's all about your intent.
Okay.
It's a Fannie Mae, Freddie Mac, the GSEs we spoke about earlier. It's in their guidelines that you can't go in with the intention of buying this house, living in it for 3 months while you renovate it, and then using it as an investment property. They want to get away from that. But again, it's all about your intent. We know, especially if you're military or circumstances happen in your life, you get divorced or you have to move. Family, I'm doing a deal for a family now. They bought a house 6 months ago. Now their mother's moving in with them.
Okay.
The house isn't big enough, so they're going to keep that house. They have to buy a bigger house to accommodate family coming.
Right.
So the circumstances are there, but we have to paint a picture for our underwriters and our investors to understand.
Sure.
So it can't be, I bought this house 3 months ago and I want to buy another one now. This one's my primary residence.
Yeah.
This wouldn't fly.
Gotcha. So 2 more points before you kind of wrap things up. That would you say to easy steps to get qualified? Last 2 kind of points.
Talking to a lender, getting everything in line. A lot of folks have money in different pots. So the best thing to do is kind of move everything into one account. Because if you have 5 different accounts and you're moving it around before settlement, the lender has to source everything. And you have to have, so if you're moving it from A to B to C, you have 3 different accounts. You're moving it into the 4th account. We're going to need 2 months of statements for all of these accounts showing where it comes from, because all the money has to be sourced for 60 days. Mm-hmm. So if we have high deposits going into this account, we're going to have to get a trail, have it coming back in here. So it's always a good idea to consolidate all your funds and get everything up front, get everything ready up front.
Right. Okay. Awesome. And then one last point, would you say?
A lot of folks don't want their credit run because they think it's going to ding their credit. Mm-hmm. I say let it be dinged, because the benefit of credit and FICO scores go in increments of 20. So if you have a 719 credit score, and we run it and it goes down to 716, it's okay, because now we have some time. If you're looking 3 or 4 months down the road, we can take that 716 up to a 740. Because like I said, it goes up in increments of 20. So 600, 680, 700, 720, 740. So we want to make sure that we get you as high of a credit score as we can to get to the lowest rate and lowest fees.
Right.
And that'll give us some time to play with that and help you get a little higher.
Perfect. Love it. Well, Scott, thank you so much for your time, man. It was a pleasure.